In this section, we will explore how the wage growth and productivity challenges are contributing to the inflationary pressures and what solutions are needed to improve them. Wage growth is the increase in the average earnings of workers over time. It reflects the balance between the demand and supply of labor, as well as the bargaining power of workers and employers. Wage growth is important for living standards, consumption, savings, investment and tax revenues. Productivity is the amount of output produced per unit of input, such as labor, capital or land. It reflects the efficiency and innovation of production processes, as well as the quality and quantity of inputs. Productivity is important for competitiveness, profitability, income distribution and economic growth. In Australia, both wage growth and productivity growth have been sluggish in recent years, falling behind other advanced economies. According to the latest national accounts, wage growth was only 2.2% in the year to June 2021, well below the long-term average of 3.5%. Meanwhile, labor productivity growth was only 0.8% in the same period, compared to a historical average of 2%. There are several factors that have contributed to this slowdown in wage and productivity growth. Some of them are: lack of job switching. A fall in job switching has reduced the mobility and dynamism of the labor market, as well as the opportunities for workers to find better paying or more productive jobs. According to a top government economist, job switching rates have declined from 11% in 2008 to 8% in fewer startups. The rate of entry for employing firms has declined to 11% in recent years, compared with 14% in the early 2000s. This has reduced the competition and innovation that new businesses bring to the economy, as well as the creation of new jobs and markets. Capital shallowing. The ratio of capital stock to labor input has declined since the end of the mining boom, implying that workers have less equipment, machinery and technology to work with. This has lowered the capital intensity and quality of production, as well as the returns to investment. Low-tech adoption. Australian businesses have fallen behind global peers in embracing disruptive technologies, such as artificial intelligence, cloud computing and robotics. This has limited their ability to improve their efficiency, quality and innovation, as well as their resilience to shocks and changes. Weak demand. The subdued growth in domestic and global demand has reduced the incentives and opportunities for businesses to invest, expand and innovate. This has also dampened the expectations and confidence of workers and employers about future income and profits. These factors have created a vicious cycle of low wage and productivity growth, which in turn has contributed to the inflationary pressures that Australia is facing. Inflation is the general increase in the prices of goods and services over time. It erodes the purchasing power of money and reduces the real value of incomes and savings. Inflation can be caused by both demand pull and cost push factors. Demand pull inflation occurs when aggregate demand exceeds aggregate supply, creating excess demand and upward pressure on prices. Cost push inflation occurs when input costs rise faster than output prices, squeezing profit margins and forcing producers to pass on higher costs to consumers. In Australia, inflation has risen sharply in recent months, reaching 3% in the year to September 2021, above the Reserve Bank's target range of 2% to 3%. This has been driven by both demand pull and cost push factors. Some of them are: supply chain disruptions. The COVID-19 pandemic has caused severe disruptions to global trade and logistics, affecting the availability and cost of raw materials, intermediate goods and final products. This has created shortages and bottlenecks in various sectors, such as construction, manufacturing and retail. Energy prices. The global energy market has experienced a surge in demand and a decline in supply, leading to soaring prices for oil, gas and electricity. This has increased the production costs for many industries, as well as the household bills for consumers. Housing market. The Australian housing market has been booming amid low interest rates, government stimulus measures and strong demand from buyers. This has pushed up house prices and rents across the country, adding to the cost of living for many Australians. Labour market. The Australian labour market has recovered strongly from the pandemic-induced recession, with unemployment falling to 4.6% in September 2021, below pre-pandemic levels. This has increased the demand for workers and the bargaining power of some employees, especially in sectors facing skill shortages or high turnover. These factors have created a mismatch between the inflationary pressures and the wage and productivity growth in Australia. While prices are rising faster than incomes, wages are not keeping up with productivity. This means that workers are not being adequately compensated for their contribution to output, and businesses are not being sufficiently rewarded for their investment in inputs. This mismatch has negative implications for the economy and society. It reduces the real income and living standards of workers and consumers, as well as the profitability and competitiveness of businesses. It also creates uncertainty and volatility in the financial markets and the monetary policy. To address this mismatch, Australia needs to implement solutions that can boost both wage and productivity growth, while keeping inflation within the target range. Some of these solutions are: enhancing job mobility. Policies that can facilitate job switching and career progression, such as improving labor market information, providing training and reskilling opportunities, reducing barriers to entry and exit, and promoting flexible work arrangements. Supporting startups. Policies that can encourage entrepreneurship and innovation, such as providing access to finance, reducing regulatory burdens, fostering a culture of risk-taking and experimentation, and creating a level playing field for new entrants. Increasing capital deepening. Policies that can stimulate investment in physical and human capital, such as providing tax incentives, lowering borrowing costs, improving infrastructure quality and availability, and enhancing education and skills outcomes. Accelerating tech adoption. Policies that can foster the diffusion and adoption of disruptive technologies, such as supporting research and development, facilitating technology transfer and collaboration, addressing digital skills gaps and digital inclusion issues, and ensuring data security and privacy. Balancing demand management. Policies that can manage aggregate demand in line with aggregate supply, such as adjusting fiscal and monetary policy settings, coordinating with international partners, targeting specific sectors or regions, and addressing structural imbalances. By implementing these solutions, Australia can achieve a more balanced and sustainable growth path that can benefit both workers and businesses, as well as the economy and society as a whole.